What if I told you that the stock market isn't just for Wall Street experts? That you could understand it and even start investing in just 10 minutes? Stick around because by the end of this video, you'll know exactly how the stock market works and how it can help you build wealth. The stock market is where fortunes are made and lost, and where the financial future of companies and individuals is shaped. It might seem like a jungle of numbers, but with a bit of knowledge, you can navigate this world with confidence. We'll break down the basics of the stock market, making complex terms easy to grasp. You'll learn what stocks are, how to buy and sell them, and strategies for making informed decisions. So grab your thinking caps and get ready to unlock the secrets of the stock market. This isn't just about making money, it's about understanding a vital part of our economy. By the end of this video, you'll be speaking the language of Wall Street and ready to start building your own investment portfolio. So what are we waiting for? Let's dive in. The world of the stock market is waiting for you. Imagine you want to bake a giant cake, but you don't have enough sugar. You have a great recipe, the perfect oven, and all the other ingredients, but you're short on sugar. What do? You could ask your neighbor for some, but what if you need even more ingredients? That's where the magic of stocks comes in. Instead of just asking one neighbor, imagine you ask everyone in your neighborhood to contribute a little bit of what you need. In return, you promise them a slice of the cake once it's baked. This way everyone gets a piece of the delicious cake and you get all the ingredients you need to make it. That's essentially how stocks work. A stock is like a tiny piece of a company. When a company wants to grow or needs money for new projects, it can sell small pieces of itself called shares to the public. When you buy a stock, you're becoming a part owner of that business. This means you have a claim on part of the company's assets and earnings. It's like owning a sprinkle on the world's biggest cupcake. Companies sell these sprinkles to raise money, which they then use to grow their business, develop new products, or hire more people. This process allows them to expand and innovate, benefiting both the company and its shareholders. Owning stock means you're along for the ride. As the company grows and becomes more successful, the value of your shares can increase. However, it's important to remember that investing in stocks also comes with risks. The stock market can be unpredictable and the value of your investment can fluctuate. But with great risk can come great rewards. By understanding how stocks work and doing your research, you can make informed decisions and potentially benefit from the growth and success of the companies you invest in. Now that you know what stocks are, you might be wondering where to buy them. Enter the stock exchange, the bustling marketplace where buyers and sellers come together to trade stocks. Think of it like a giant online auction house, but instead of bidding on vintage furniture, you're buying and selling pieces of companies. Some famous examples of stock exchanges include the New York Stock Exchange and the Nasdaq. These exchanges provide a platform for investors to connect and trade stocks with transparency and fairness. They ensure that prices are publicly available and that all investors have access to the same information. It's like a well-regulated flea market for company shares. You wouldn't try to climb Mount Everest without a guide, would you? Similarly, navigating the stock market requires a little help from a financial expert, a stockbroker. Brokers are licensed professionals who act as intermediaries between you and the stock exchanges. They execute your buy and sell orders, provide investment advice, and help you manage your portfolio. Think of them as your personal Sherpas on your climb to financial success. In today's digital age, you can choose between traditional brokers who offer personalized guidance and online platforms that allow you to trade independently. Whichever route you choose, make sure to do your research and find a broker who aligns with your investment goals and risk tolerance. So why would a company choose to share ownership by issuing stock in the first place? Well, there are several reasons why going public can be a smart move for businesses looking to reach new heights. Firstly, issuing stock allows companies to raise large sums of capital without taking on debt. Instead of borrowing money from a bank and paying interest, they can sell shares to investors who are essentially betting on the company's future success. Secondly, going public can increase a company's visibility and prestige. Being listed on a major stock exchange can boost brand awareness, attract potential investors and customers, and enhance the company's overall reputation. Section 6. common versus preferred, picking your piece of the pie. Not all stocks are created equal. In fact, there are two main types of stock, common and preferred. Understanding the difference between them is crucial for making informed investment decisions. Common stock is the most prevalent type of stock. It gives investors voting rights in company decisions such as electing board members or approving mergers. Common stockholders also have the potential to earn dividends, which are portions of the company's profits distributed to shareholders. Preferred stock, on the other hand, typically doesn't come with voting rights. However, preferred stockholders have priority over common stockholders when it comes to receiving dividends and getting their money back if the company goes bankrupt. It's like having a VIP pass to the company's profits. Section 7. The Price is Right? Supply and demand in action. Ever wondered how stock prices are determined? It's a question that intrigues many, especially those new to investing. It's all about the age-old forces of supply and demand. These fundamental principles govern not just the stock market, but many aspects of our daily lives. Just like the price of your favorite sneakers fluctuates based on how many people want them, the stock market operates on similar dynamics. Stock prices rise and fall depending on investor sentiment. This sentiment can be influenced by a variety of factors, making the market a complex and ever-changing environment. When more investors are bullish or optimistic about a company's future prospects and want to buy its stock, demand increases, driving up the price. This optimism can stem from positive earnings reports, new product launches, or favorable market conditions. Demand increases, driving up the price. This can create a positive feedback loop where rising prices attract more investors, further boosting demand. Conversely, if investors become bearish or pessimistic and start selling their shares, supply outweighs demand, causing the price to drop. This pessimism can be triggered by poor financial performance, economic downturns, or negative news. Supply outweighs demand, causing the price to drop. This can lead to a downward spiral where falling prices prompt more selling, further depressing the stock's value. Numerous factors can influence investor sentiment and impact stock prices, including company performance, economic conditions, industry trends, geopolitical events, and even rumors and speculation. Each of these elements can play a significant role in shaping market dynamics, and even rumors and speculation. In today's fast-paced world, information travels quickly, and even unverified news can cause significant market movements. It's a complex interplay of factors that keeps the stock market constantly moving and shaking. Understanding these dynamics can help investors make more informed decisions and navigate the often turbulent waters of the financial markets. Section 8. The roller coaster ride, risks and rewards. Investing in the stock market is like riding a roller coaster. It can be exhilarating and potentially profitable, but it also comes with its fair share of risks. One of the biggest risks is market volatility. Stock prices can fluctuate significantly in the short term, and investors can lose money if they buy at a high price and are forced to sell at a low price. It's essential to have a long-term investment horizon and not panic sell during market downturns. However, despite the risks, investing in stocks offers the potential for significant rewards. Over the long term, the stock market has historically trended upwards, and investors who hold on to their investments through market cycles have the opportunity to grow their wealth substantially. Section 9. Ready to dive in? Starting your investment journey. Congratulations, you've made it through our crash course on the stock market. Now that you understand the basics, you're ready to embark on your own investment journey. Start by setting clear financial goals and determining your risk tolerance. Consider investing in low-cost index funds that track the performance of the overall market. Diversify your portfolio by investing in a mix of stocks from different sectors and industries. Remember, investing is a marathon, not a sprint. Be patient, stay informed, and don't be afraid to seek professional advice when needed. With time, education, and a little bit of luck, you too can ride the waves of the stock market and achieve your financial dreams. Thank you for watching our video on the stock market. We hope you found it informative and engaging. Don't forget to like, share, and subscribe for more insightful content. Happy investing!